Hello? So let's talk about accounting. I know, the word itself might conjure images of dusty ledgers, tiny green visors, and someone muttering about amortization schedules. It sounds complicated, maybe even a little boring? But I want to propose a different idea. Accounting is not just about numbers. It's about telling a story. It's the story of a business, of a project, of your personal finances. It's the language that money speaks. And learning just a little bit of it can be incredibly empowering. It's a superpower that helps you understand the world in a fundamentally new way, revealing the hidden mechanics behind everything from your favorite coffee shop to multinational corporations. Think about your own life for a second. Do you have a budget? Have you ever saved up for something big like a new phone or a trip? If you have, then congratulations, you've already done some accounting. You tracked your income, monitored your spending, and made a plan to reach a financial goal. That is the core, the very heart of what accounting is all about. It's organizing financial information to make it useful. So when we talk about accounting, we're often talking about two different but related disciplines. Think of them as two sides of the same coin. First up, we have financial accounting. This is the type of accounting that looks outward. Its main goal is to prepare financial reports for people outside of the company. Who are these people? They could be investors who are thinking about buying shares of the company. They could be banks deciding whether to give the company a loan. Because financial accounting is for an external audience, it has to follow very strict rules. This allows you to compare the financial health of, say, Ford and Toyota. The primary reports that financial accounting produces are the income statement, the balance sheet, and the statement of cash flows. It's like the company's official report card. On the other side of the coin, we have managerial accounting. As the name suggests, this type is for the managers inside the company. It's all about creating detailed, customized reports that help managers make day-to-day and long-term decisions. Should we launch a new product? Should we close our factory in Ohio and open a new one in Texas? Unlike financial accounting, managerial accounting doesn't have to follow any strict, externally imposed rules. The reports can be whatever the managers find most useful. The focus here is on the future, on planning and decision-making. All right, so we've established that financial accounting has rules, a lot of rules. In the United States, these rules are collectively known as GAAP, which stands for Generally Accepted Accounting Principles. It sounds very official, and it is. GAAP is the common set of standards and procedures that companies must follow when they prepare their external financial statements. It's the rule book that ensures everyone is playing the same game. Without GAAP, every company could report its finances in its own unique, creative way, which would make it impossible to compare them. GAAP is primarily set by an independent organization called the Financial Accounting Standards Board, or FASB. These are the people who spend their days thinking about the best and fairest way to account for all the complex transactions a modern business can have. Their goal is to make sure that financial information is relevant, reliable, and comparable. This creates trust in the financial markets. When you look at a company's financial report and you know it follows GAAP, you can have a certain level of confidence that the information is a faithful representation of what's actually going on with the business. Now, you don't need to memorize the entire GAAP rulebook. It's enormous and incredibly detailed, but it's useful to understand the core principles that guide it. For example, there's the cost principle, which says you should record assets at their original cost. There's the revenue recognition principle, which guides when you can officially record that you've earned money. And there's the matching principle, which says you should match your expenses to the revenues they helped generate. It's also worth noting that GAAP is specific to the United States. Much of the rest of the world uses a different but similar set of rules called the International Financial Reporting Standards, or IFRS. The key takeaway is that financial accounting is not a free-for-all. GAAP is the referee, making sure the game of business is played fairly for everyone. If there is one single concept that you take away from this entire discussion, let it be this one: the accounting equation. It is the bedrock, the foundation, the DNA of all accounting. And wonderfully, it's beautifully simple. Are you ready? Here it is. Assets equals liabilities plus equity. That's it. That's the whole thing. Everything in accounting, from the simplest transaction to the most complex corporate financial statement, is built upon this elegant and perfectly balanced equation. It must always be in balance. Always. No exceptions. It's like a law of physics for business. So what does it mean? Let's break it down. Assets are all the valuable things a company owns. We'll get more into this later, but think of things like cash, buildings, and equipment. The other side of the equation shows who has a claim on those assets. There are only two possibilities. Either an outsider has a claim, which is a liability, like a loan from a bank, or an insider, the owner, has a claim, which is equity. So the equation is really saying, the stuff the company owns, assets, is claimed by either outsiders, liabilities, or insiders, equity. Let's use a super simple example. Imagine you want to start a lemonade stand. You buy a fancy new juicer for $100. To do this, you use $40 of your own money and you borrow $60 from your parents. Let's see how this fits into our equation. Your asset is the juicer, worth $100. The money you borrowed from your parents is a liability. You have to pay it back. The money you put in yourself is your ownership stake, your equity. Let's check the equation. $100 in assets equals $60 in liabilities plus $40 in equity. It balances. Perfect. Every single transaction a business makes will affect this equation, but it will never, ever unbalance it. Let's say you make a $10 payment on the loan to your parents. Your cash goes down by $10, but your loan also goes down by $10. The equation remains balanced. Okay, let's zoom in on the first part of our grand equation. Assets. An asset is simply any resource with economic value that a business owns or controls with the expectation that it will provide a future benefit. It's the good stuff. Think of a pizza place. What are its assets? The oven, the cash in the register, the delivery car, the building if they own it, and even the stacks of flour and cheese in the back. All of these are resources that help the pizza place make and sell pizzas, which in turn makes money. Assets are usually broken down into a couple of categories, most commonly current assets and non-current assets. Current assets are things that are expected to be converted into cash, sold, or used up within 1 year. The most obvious current asset is cash itself. Others include accounts receivable, which is money owed to the business by customers who bought stuff on credit, and inventory, which is all the raw materials and finished goods waiting to be sold. For our pizza shop, the flour, cheese, and pepperoni would be inventory, a key current asset. Non-current assets, sometimes called long-term assets, are resources that the business plans to keep and use for more than 1 year. These are the big-ticket items that aren't for sale. This includes things like property, plant, and equipment, often abbreviated as PP&E. For our pizza shop, the oven, the building, and the delivery car are all non-current assets. Intangible assets also fall into this category. These are valuable things you can't physically touch, like patents, copyrights, and a brand's reputation, called goodwill. The secret recipe for the pizza sauce could be considered an intangible asset. Understanding a company's assets is crucial to understanding its health and potential. By looking at the asset side of the balance sheet, you can get a real sense of the resources the company has at its disposal. It's the part of the story that tells you what tools the hero has on their quest. The assets tell the tale. Now for the other side of our equation, liabilities and equity. If assets are what a company owns, liabilities and equity are who has a claim to those assets. Let's start with liabilities. A liability is a company's financial obligation or debt. It's money that the company owes to others. It's the IOU section of the financial story. These are claims on the company's assets held by outsiders like banks, suppliers, and even employees. It's a responsibility that must be settled in the future, usually by paying cash. Just like assets, liabilities are broken down into current liabilities and non-current liabilities. Current liabilities are debts that are due within 1 year. A very common example is accounts payable, which is the money a company owes to its suppliers for goods or services it bought on credit. If our pizza shop bought flour from a supplier and promised to pay them in 30 days, that amount would be an accounts payable. Other current liabilities include short-term loans, wages payable, that's salaries owed to employees, and taxes payable. These are the immediate bills that need to be managed carefully. Non-current liabilities, or long-term liabilities, are debts that are due more than 1 year from now. These are typically larger, more structural debts. The most common examples are long-term bank loans, bonds payable, or a mortgage on a building. If our pizza shop took out a 5-year loan to buy its fancy new oven, that loan would be a non-current liability. Finally, we have equity, which is also known as owner's equity or shareholder's equity. This is what's left over after you subtract total liabilities from total assets, remember? Assets minus liabilities equals equity. It represents the owner's claim on the assets of the business. It's the value that belongs to the insiders. Equity comes from 2 main sources: money invested by the owners, called paid-in capital or common stock, and profits that the company has earned and kept in the business, called retained earnings. For our lemonade stand, your initial $40 investment was equity. It's the portion of the assets that you, the owner, truly own, free and clear. So, the accounting equation gives us a snapshot in time. But how does a business actually grow its equity? How does it become more valuable? The answer lies in 2 incredibly important concepts: revenue and expenses. These are the terms that describe the flow of money in and out of a business through its operations. Let's start with the good one: revenue. Revenue is the income a company generates from its normal business activities, which is usually the sale of goods or services to customers. For our lemonade stand, every time you sell a cup of lemonade for $1, you are generating $1 of revenue. Revenue is the top line of a company's income statement, which is why you often hear people talk about a company's top-line growth. It's the total amount of money flowing in from sales before any costs are taken out. It's important to know about the revenue recognition principle we mentioned earlier. Generally, you can only record revenue when it's been earned, meaning you've delivered the product or service, regardless of whether you've actually been paid yet. Of course, it takes money to make money, and that brings us to expenses. An expense is the cost of doing business. It's the money a company spends to generate revenue. In order to sell that $1 cup of lemonade, you had to spend money on lemons, sugar, and cups. Those are all expenses. For a larger business, expenses include a huge range of things: the cost of the goods it sells, employee salaries, rent for its office space, utility bills like electricity and internet, and marketing costs to attract customers. These are the costs incurred in the process of earning revenue. The relationship between revenue and expenses is what determines if a business is successful. If your revenue is greater than your expenses, you have a net income, also known as profit. Congratulations, you're making money. Your equity increases because you've created more value. If your expenses are greater than your revenue, you have a net loss. This is not ideal, as it means your equity decreases. The goal of any business is to maximize revenue while controlling expenses to generate a healthy profit. This simple dynamic, what you bring in versus what you send out, is the engine of business. So we've defined all these terms: assets, liabilities, equity, revenue, expenses. But why go to all this trouble? Why meticulously track every single penny? The answer is simple: because accounting information is the foundation for making smart decisions. It transforms guesswork and gut feelings into strategy and evidence-based action. Both for people inside the company, like managers, and people outside the company, like investors, accounting provides the critical data needed to navigate the complex world of business. It's the map and the compass for the journey. For managers running the business, accounting is indispensable. The reports from managerial accounting help them answer vital questions every single day. Is one product line more profitable than another? Should we invest in new machinery to become more efficient? Do we have enough cash on hand to pay our employees and suppliers next month? By analyzing financial data, managers can identify trends, spot problems before they become crises, and allocate resources to the areas where they will be most effective. Without accounting, they would be flying blind, making decisions based on hunches rather than hard facts. For those outside the company, financial accounting is just as crucial. Imagine you're an investor trying to decide where to put your money. Would you rather invest in Company A, which provides clear, audited financial statements showing a history of growing profits, or Company B, which offers no financial information at all? The choice is obvious. Financial reports allow investors to assess a company's health and potential for future growth. They can analyze ratios, compare the company to its competitors, and make an informed decision about whether it's a good investment. It levels the playing field and promotes a more efficient allocation of capital in the economy. Even on a personal level, these principles are powerful. Applying basic accounting to your own finances can be life-changing. Tracking your income, revenue, and spending expenses can help you create a budget, pay down debt, which are liabilities, and build your savings, which increases your personal equity. It allows you to make conscious decisions about your money, like whether you can afford a vacation or should start investing for retirement. Whether you are running a multinational corporation or just your own household, the principle is the same. Good information leads to good decisions. Accounting is the system that provides that good information. So there we have it. Accounting is not a secret code designed by and for math geniuses. It is a logical, elegant language that tells the financial story of an organization. We've seen that it's all built on one simple, powerful idea: assets equals liabilities plus equity. This equation is the heart of a system that must always, always stay in balance. It provides a snapshot of what a company owns and what it owes at a single moment in time. It is the fundamental truth of any business, from a child's lemonade stand to a global tech giant. We've explored the key characters in that story. We have assets, the valuable resources the company uses to operate. We have liabilities, the debts owed to outsiders, and equity, the value belonging to the owners. And we've seen how the plot moves forward through revenue, the money that flows in from sales and expenses, the costs of running the business. When revenue outpaces expenses, the company generates a profit, its equity grows, and the story has a happy chapter. This is the dynamic engine of capitalism, and now you understand how it's measured. We also learned that there are different types of accounting for different audiences. Financial accounting, guided by the strict rules of GAAP, prepares formal reports for the outside world, ensuring transparency and comparability. Meanwhile, managerial accounting provides flexible, forward-looking information for insiders, helping them make the strategic decisions that guide the company's future. Both are essential, serving as the trusted source of information that allows our complex, modern economy to function, fostering trust between businesses, investors, and lenders. I hope this has demystified the world of accounting for you. My real hope is that you see it not as a chore, but as an adventure. It is a tool for understanding, a framework for decision-making, and a language that empowers you, whether you're a student, an aspiring entrepreneur, or just someone who wants to better understand the world. This is just the beginning, of course. There's so much more to learn. But you now have the foundation. You have the key concepts. And the next time you hear someone mention assets or revenue, you'll know exactly what they're talking about. The story of business is written in the language of accounting, and now you can read it.